Every big AI company you can name is losing money. OpenAI reportedly burns billions of dollars a year, and across the industry, spending more than you earn isn't a bug, it's the official strategy. But buried in the 2026 IPO pipeline, among the trillion-dollar hopefuls and the cash furnaces, there is exactly one AI company that reports an actual profit. It's worth around $134 billion. It pulls in over $5 billion in annual revenue. And here's the part that should make every founder pay attention. It was started by 7 university academics who spent 3 straight years trying to give their technology away, and couldn't find a single company willing to take it seriously. This is the story of Databricks, and by the end of this video you'll understand why, in a gold rush, the most boring-looking company on the map might be the one that actually keeps the gold. Rewind to 2009. A PhD student at UC Berkeley named Matei Zaharia builds a piece of software called Spark inside a research lab. Spark does something that sounds dry but turns out to be enormous. It processes massive amounts of data dramatically faster than the standard tools of the era. The team open sources it in 2010, which means anyone on Earth can use it for free. You'd think companies would line up. They didn't. From 2009 to 2012, the Berkeley team pitched Spark to company after company, and according to accounts of the early days, essentially nobody bit. No adoption, no interest, no budget. The technology that would later underpin a $100 billion business spent 3 years as a free product nobody wanted. Think about how absurd that is for a second. These weren't salespeople with a bad pitch, they were the literal inventors of the fastest data engine in the world, handing it out for free, and the market shrugged. The problem wasn't the product. It was timing. In 2010, most companies didn't yet have data problems big enough to feel the pain Spark solved. The team was selling a cure for a disease their customers hadn't caught yet. Keep that in mind the next time you see an overnight AI success story, because the overnight part is almost always fiction. And what happened next came down to one investor seeing something everyone else missed. In 2013, the 7 researchers finally incorporated as a company, Databricks. 7 academics, and by their own admission, not one of them had ever run a business. The turning point came from Ben Horowitz at Andreessen Horowitz, one of Silicon Valley's most famous venture firms. While the rest of the market saw a niche open-source tool, Horowitz reportedly believed a $100 billion company could be built around Spark. He valued the tiny startup at $50 million and put in $14 million. The founders accepted on the spot. Now run the math on that conviction, from a $50 million valuation in 2013 to roughly $134 billion in late 2025, that's the original bet multiplying more than 2,500 times over. But the money alone didn't solve their real problem. They still had to figure out the thing that kills most open source companies: how do you charge for something the whole world already gets for free? Here's the trap of open source: your product is your best marketing, and also your biggest competitor. Anyone could download Spark, so Databricks couldn't sell Spark. Instead, they sold everything around it, a managed cloud platform where companies could run Spark without hiring an army of engineers to babysit it. You're not paying for the engine, you're paying to not think about the engine. It took years. By most accounts the company only found true product market fit around 2018, 5 years after founding and nearly a decade after the original code was written. But once it clicked hard, because Databricks had positioned itself as the layer where companies store, clean, and process their data. And then something happened that turned that boring position into the most valuable real estate in technology: the AI explosion. Because every single AI model, every chatbot, every enterprise AI project runs on one raw ingredient: data. And Databricks was already the plumbing. There's an old line about the California gold rush: the miners went broke, but the people selling picks and shovels got rich. In the AI gold rush, the miners are the model companies, burning billions on GPUs and training runs, racing each other to build smarter chatbots, most of them deep in the red. Databricks took the pickaxe position. It doesn't need to win the model war. Whoever wins, they need data pipelines, data storage, data governance, and thousands of enterprises already run that through Databricks. The numbers tell the story. As of its December 2025 funding round, Databricks reported a $5.4 billion annual revenue run rate, growing around 65% year over year. Its net retention rate is reportedly above 140%, meaning existing customers don't just stay, they spend 40% more each year. Over 20,000 customers. And unlike essentially everyone else in AI, positive free cash flow. Real money in, less money out. In 2026, that shouldn't be remarkable. It is. So why is one company profitable while the giants bleed? It comes down to what each business has to buy. AI labs have brutal costs that scale with success. Every new user means more compute, and compute means paying for some of the most expensive hardware on Earth. Some reports estimate the leading labs spend billions per year more than they earn. Their bet is that scale eventually flips the equation. Maybe it will. But Databricks sells software on top of infrastructure its customers largely pay for themselves. When a bank runs a massive data job on Databricks, the underlying cloud bill mostly flows to Amazon, Microsoft, or Google. Databricks collects the software margin. High gross margins, costs that don't explode with usage, and customers locked in by the sheer gravity of their own data. Because that's the quiet superpower here. Once a company has moved years of data, pipelines, and internal tools onto a platform, leaving isn't a decision, it's a migration project measured in years and millions of dollars. Nobody rips that out to save a few percent. So while AI labs fight a knife fight for users who can switch chatbots in one browser tab, Databricks customers are effectively cemented in place. That's not a moonshot business model. It's an old-fashioned one, wearing an AI jersey. And Wall Street has noticed. On secondary markets, Databricks shares have reportedly traded at prices implying a valuation above $170 billion, investors paying a premium for the one AI story that doesn't require faith in future profits, because the profits already exist. Which brings us to what's next. Databricks has raised private money at $134 billion, added $1.8 billion in debt in early 2026, and is widely reported to be preparing an IPO for late 2026 or early 2027. Potentially the largest enterprise software IPO in history. Meanwhile, OpenAI has reportedly filed confidentially for its own listing targeting over $1 trillion. So the market is about to run a fascinating experiment, the profitable pickaxe seller versus the loss-making gold miners, priced side by side in public markets. Nobody knows which bet pays off, and to be clear, none of this is investment advice. But the lesson for anyone building anything is already on the table. 7 academics. A free product nobody wanted for 3 years. One investor who saw a $100 billion company where everyone else saw a science project. And a strategy so unfashionable it sounds radical in 2026, sell something businesses need, charge more than it costs you, repeat. The AI race is full of companies asking investors to believe in a profitable future. Databricks is the rare one that just built a profitable present. In a market